Hey, it's Dan Morales, America's Mortgage Man. And so one issue that I have, that I'm running into a lot lately, okay? And this is a problem for folks who have a house that they want to sell because they maybe want to move up to a newer property or bigger property, or they want to buy something different. But one of the concerns that a lot of folks are having is what happens if I put my house up for sale and I sell my house right away, but I can't find something to buy? What am I going to do? I could potentially be homeless or, without a property. Well, that could be a challenge in today's very competitive housing market. So there's a really unique product that we offer that oftentimes clients are not aware of because not every lender offers a product like this. This is what's known as a bridge loan, okay? What a bridge loan allows you to do is it allows you to pull cash or equity out of a property that you currently own or live in and use a portion of that equity to purchase the property that you want to buy. So in other words, you would be able to write an offer that is non-contingent on the house that you're going to buy, which makes your offer, one, more competitive, but two, it gives you that peace of mind of knowing that you have your new place locked in and secured without having to worry about selling your current place first and potentially being at risk of not having a place to live in, okay? So let's talk about how that works. I'm gonna show you on the screen here. We're gonna go high tech with the illustrations right now. All right, so what we've got is we've got a current house, let's say that we own right now. Let's call that house maybe worth $250,000. And then let's just say we have a new house we wanna buy that is $400,000, okay? And what we're going to do is we're going to separate these two, right? So we have our current home here, and then we have our new house that we're going to buy over here, okay? Now, with the way the bridge loan works, you're limited to a maximum of 80% of what that house is worth, meaning that I can give you a bridge loan of up to, let's say in that scenario, $200,000. Now, what I'm going to do as part of that bridge loan, though, is I'm going to pay off any first mortgage you have, and I'm going to pay off, let's say, any home equity loans or second mortgages that you have on the property currently, okay? So let's just say you have a first mortgage that has a balance of, $120,000, and maybe you have a small home equity loan that has a balance of $30,000. Those two loans would be paid off, and the payments that are associated with those two loans would go away, okay? So if I pay those two loans off, that means I've got approximately $50,000 that would be available that could be used towards the purchase of our new house, okay? That $50,000 would be enough, let's say, to fund a down payment of 10% into the new house. So in that scenario, what we'd have is we'd have a down payment of, let's say, 10% in that scenario, which means we'd finance the remaining balance, which would be $360,000 on a new mortgage. Now, what happens is, you got to remember that you have, let's say, your 10% down payment that you would have, but you also are going to have some closing costs and escrows as part of that as well too. So by taking up to or having up to $50,000 available, we do have the ability to be able to have a little bit of cushion or margin there as part of what we're doing, okay? So what we got is we got a new mortgage, let's say for $360,000 on our new house, and that mortgage could be whatever option we wanted to go with. Maybe we did a 30-year fixed, maybe we did a 20-year, or whatever, 15-year, whatever you felt comfortable with and whatever you legitimately qualified for, okay? So what happens here is we have our current house over here. This is the house that we are going to sell as part of the transaction. We have a new loan on that current house for $200,000. That loan has an interest-only payment that's tied to it, okay? So it's interest-only on a per-month basis. We're not paying any escrows for taxes, insurance, or anything like that. We're just paying the interest that is due on a per month basis. And that, if you will, covers what our cost is to maintain that property until we sell that house. On the new house, we'd have our permanent mortgage in place, whether it be a 30-year term, 20-year term, or 15-year term. You would start to make your full principal and interest payment, plus any taxes, plus any insurance and any mortgage insurance if it was applicable as part of what you're doing, okay? So what happens is you have the new mortgage payment on this property, and you have the interest-only payment on your current property. What you don't have is you don't have the mortgage payment that's associated with that first mortgage any longer, and you don't have the mortgage payment that would be associated with any home equity loan or anything like that. So those two payments, if you had them, would go away as part of what we're doing. You'd have the one interest-only payment, and then you'd have the one payment on the new property of principal and interest as part of what we're doing, okay? So what happens is that makes it a lot more affordable to own the two properties in the time being, why you could potentially have the two properties. Now, keep in mind, one of the key components of this kind of loan structure being something that could work well for you is working with a good, experienced realtor, because in a very competitive housing market, your current property that you would be taking the bridge loan against, you ideally price it right and you sell it relatively fast. If you sell it fast, that means that this loan would be paid off with the sale of your property, and this property goes away, the payments go away, the bridge loan goes away, and then we just have our mortgage on the new house, okay? So what that does is that gives us the ability to be able to close on that new property without having our current house sold, which means we can present our offer as non-contingent, meaning that it's not contingent upon the sale of our current house. It makes our offer that much more stronger compared to somebody else who maybe has a house to sell or maybe is less qualified than what we are. You know, our challenge really, oftentimes in this type of scenario, really just comes down to timing, meaning that we really don't want to sell that current house until we know that we have a new house to buy. Well, if we're trying to buy the new house without the current house sold, it makes our offer that much less competitive, which means we have a higher probability of losing in a multiple offer situation, where if we're doing a bridge loan, we don't have that current house that we have to worry about squaring up on, let's say prior to closing of the new place, because we're going to use the bridge loan to be able to get us across the finish line, if you will, on the new property prior to this house being sold, which gives you a competitive advantage. I'm Dan Morales, America's Mortgage Man. I'd love to go through the specifics of this type of, if you will, loan structure that could benefit you as part of your home buying process, and especially for those of you who, of course, have a house that you're going to be selling as part of the purchase of a new home, and you're really concerned about putting that house for sale and potentially being homeless. This could be the solution that you need to have to get you across the finish line. So again, I'm Dan Morales, America's Mortgage Man. My phone number is 616-931-4629. My NMLS number is 709729. And of course, North Point Bank is an equal housing lender. Have a great day.